Vance stayed home. Goldman cut its target. Silver hit $63. Full Sunday breakdown. Last week, three things happened that almost nobody connected. J.D. Vance canceled the Burgenstock peace talks. Goldman Sachs quietly cut its silver price target, and silver hit $63 an ounce, its highest level in over a decade. Three separate headlines, three separate news cycles. Most people saw none of them clearly, but when you put them together, the picture that emerges is one of the most important macro setups I've seen in years. Stay with me, because by the end of this video, you're going to understand exactly what is happening and why the average investor is completely unprepared for what comes next. Here's what we're going to break down today. Why did a diplomatic cancellation in Switzerland send shockwaves through commodity markets? Why did Goldman Sachs, one of the most powerful financial institutions on the planet, cut its silver target at the exact moment silver was breaking out to the upside? And what does the Federal Reserve's increasingly impossible position have to do with all of this? Most investors are looking at silver as just another commodity, a shiny metal, a niche asset for preppers and stackers. That is a fundamental misread of what silver has become in 2026. This is no longer just a precious metal story. This is a geopolitical story, a monetary story, a story about what happens when the institutions that are supposed to stabilize the global financial system start contradicting each other in public. Pay close attention, because what's unfolding right now is exactly the kind of setup that, historically, precedes the largest commodity moves of a generation. Section 1. Vance stayed home. Let's start in Switzerland. The Burgenstock talks were supposed to be a framework for de-escalation, a diplomatic channel, a signal to global markets that the geopolitical temperature was coming down. J.D. Vance didn't show up. Now, in isolation, a cancelled diplomatic meeting is a news story. Politicians cancel things all the time. But in the context of what's happening across global commodity markets, currency reserves, and defense spending, this was a signal. Here's why it matters for silver specifically. When geopolitical risk rises, institutions move. Central banks accelerate reserve diversification. Defense procurement increases. Electronics manufacturing, which is one of the single largest consumers of silver on the planet, gets prioritized. Supply chains get reshored or restructured. And throughout all of that, silver sits at the intersection of every single one of those trends. Silver isn't just a store of value. It is an industrial metal. It is used in solar panels, electric vehicles, semiconductors, defense electronics, and medical technology. When the geopolitical temperature rises, the demand side of silver's equation doesn't weaken, it strengthens. And the Vance cancellation was a signal that the geopolitical temperature is not coming down anytime soon. Markets read that. Perhaps not consciously, perhaps not in a single headline, but smart money reads geopolitical signals, and smart money moved last week. Here's the deeper point most commentators missed entirely. The Burgenstock talks represented a potential ceiling on risk, a potential moment where the world stepped back from the edge. When that ceiling collapsed, when Vance stayed home, the risk premium that had been slowly deflating got injected straight back into the market, and silver, which had been consolidating below $60 for weeks, broke through. That is not a coincidence. That is macro cause and effect playing out in real time. Section 2. Goldman's cut. Now here's where it gets interesting. At the same moment silver was breaking out, Goldman Sachs cut its silver price target. Let that sit for a moment. One of the most sophisticated trading desks on Wall Street, an institution with more information flow, more analytical horsepower, and more market access than virtually any other entity on the planet, issued a downward revision on silver, right as silver was moving higher. How do we make sense of that? There are two ways to interpret a Goldman target cut. The first interpretation is the obvious one. Goldman thinks silver is overvalued. Goldman's analysts ran their models, looked at the supply-demand picture, assessed Fed policy expectations, and concluded the price is ahead of fundamentals. Take the downgrade at face value, reduce your exposure, move on. That is how most retail investors will process this, and that is exactly why most retail investors consistently buy high and sell low. The second interpretation requires more intellectual honesty about what institutional research actually is. Goldman Sachs is not just an analyst firm. It is one of the largest trading operations in the world. It has positioning. It has inventory. It has clients on both sides of the silver market. When Goldman publishes a price target, that target is not issued in a vacuum. It is issued by an institution that benefits in very specific ways from how retail sentiment moves in response to that target. I'm not saying Goldman is lying. I'm saying the relationship between institutional research and institutional positioning is more complex than most retail investors understand. Here's the historical context that matters. In 2010 and 2011, as silver was making its historic run from $18 toward nearly $50, major institutional voices repeatedly called the top. They were wrong for 2.5 years, and the investors who followed those calls, who trusted the institutional consensus over the fundamental picture, missed one of the most significant commodity moves of the modern era. Now, am I saying silver is going to repeat that move? No. I am saying that institutional price targets are not the same as fundamental analysis. And right now, the fundamental picture for silver is one of the strongest it has been in decades. Let me show you why. The global silver supply deficit is structural. It is not a short-term blip. Industrial demand, driven by the energy transition, by AI infrastructure, by defense electronics, is consuming silver at a rate that mining supply simply cannot keep pace with. The Silver Institute has documented consecutive years of supply deficit. Above-ground inventories are declining. COMEX-registered stocks have been under sustained pressure. When you have a structurally deficient physical market and institutional voices are issuing downward revisions and retail sentiment is wavering, that is historically one of the most powerful setups in commodity investing. Goldman cutting its target may end up being remembered as one of the most perfectly timed contrarian signals of 2026. Section 3. The Federal Reserve's impossible position. Now let's talk about the elephant in the room. The Federal Reserve. Because everything we've discussed, the geopolitical risk, the silver price movement, the institutional positioning, exists within a monetary framework that is becoming increasingly unstable. Here's where we are. The Fed has spent the last 2 years trying to walk a razor's edge. On one side, inflation that refuses to fully surrender. On the other side, an economy that is showing clear signs of credit stress, with commercial real estate deteriorating, regional banks under pressure, and consumer debt at levels that historically precede significant slowdowns. The dot plot, the Fed's own projection of where interest rates are heading, has become almost meaningless as a forecasting tool. It has been revised so many times in so many directions that institutional traders now treat it as a sentiment indicator rather than a policy roadmap. And Kevin Warsh, who is increasingly being discussed as a potential future Fed chair, has been publicly signaling a willingness to tolerate higher rates for longer than the market expects. If Warsh is right, if rates stay higher for longer, if the Fed continues to prioritize inflation credibility over growth support, what does that mean for silver? Here's where most analysts get it completely wrong. The conventional wisdom says higher rates are bad for precious metals because they increase the opportunity cost of holding non-yielding assets. Gold goes down, silver goes down. That's the model. But that model was built for a different monetary era. It was built for a world where higher rates successfully cooled inflation without damaging the real economy. It was built for a world where the dollar's reserve status was unchallenged. It was built for a world where debt levels were manageable. We no longer live in that world. In the current environment, higher rates for longer means something very specific. It means debt service costs for the US government are rising at a pace that is fiscally unsustainable. The Congressional Budget Office has already flagged that interest payments on the national debt are on track to exceed defense spending. That is not a theoretical risk. That is a mathematical trajectory that is already underway. When bond markets begin to price in fiscal instability, when the risk premium on US Treasuries rises, the relationship between rates and precious metals inverts. Instead of higher rates being bearish for silver, they become bullish. Because rising rates in a debt-saturated system signal not monetary strength, but monetary distress. We saw the early version of this inversion in 2022 and 2023. Gold and silver held their ground and ultimately moved higher, even as rates rose to levels not seen in decades. If the Fed is trapped, if raising rates damages the economy and cutting rates reignites inflation, then the monetary credibility that has backstopped dollar confidence for 50 years begins to erode. And when monetary credibility erodes, hard assets, physical assets that cannot be printed, become the escape valve. Silver, historically, is one of the most effective escape valves in existence. Section 4. The structural story. Let me step back from the short-term noise for a moment. Because the most important context for what's happening with silver right now is not last week's diplomatic cancellation. It is not Goldman's target cut. It is not even the Fed meeting minutes. It is the structural supply-demand picture that has been building quietly for years and that is now beginning to assert itself in price. Here is what the math looks like. Global silver demand from solar panel manufacturing alone has more than doubled in the past 5 years. The International Energy Agency projects that solar capacity will continue to expand aggressively through 2030 and beyond. Each gigawatt of solar capacity requires a meaningful amount of silver, not as a decorative component, but as a functional conductor that cannot easily be substituted. Simultaneously, electric vehicle production is scaling globally. Silver is used in EV charging infrastructure, in power management systems, in the vehicles themselves. As the energy transition accelerates, regardless of which political party or government is driving it, silver consumption rises. And then there's AI. The data center build-out required to support artificial intelligence infrastructure is staggering. The cooling systems, the circuit boards, the semiconductor components, all of them consume silver. The AI infrastructure boom, which every major technology company on the planet is investing in, is a silver demand story that almost nobody in the precious metals community is talking about loudly enough. On the supply side, the picture is equally stark. Primary silver mines, mines where silver is the main product rather than a byproduct, are becoming increasingly rare. The majority of silver production comes as a byproduct of copper, zinc, and lead mining. That means silver supply is not primarily driven by silver price. It is driven by the economics of base metal mining. When copper or zinc demand softens, mine operators cut production, and silver supply falls as a consequence, even if silver prices are rising. The lag time between a silver price increase and a meaningful supply response is measured in years, not months, years. Because opening a new mine requires permitting, environmental review, capital allocation, construction, and ramp-up, a process that typically takes 5 to 10 years from discovery to production. This is the structural setup that Goldman's price target does not fully capture. This is the setup that short-term traders anchored to rate expectations are missing. This is the setup that gives the current silver move, despite the headline noise, a fundamental underpinning that feels very different from the speculative frenzies of the past. Section 5. De-Dollarization and the Global Reset. There is one more dimension to this story that I want to address directly, because it is the dimension that most mainstream financial media is the most reluctant to discuss seriously: de-dollarization. The gradual and in some cases not so gradual, shift by BRICS nations and their trading partners away from dollar-denominated settlements is not a fringe thesis. It is a documented, ongoing process. China and Russia settled a record percentage of bilateral trade in local currencies last year. Saudi Arabia has opened formal discussions about invoicing a portion of oil exports in currencies other than the dollar. Central banks globally have been accumulating gold at a pace not seen since the 1960s. What does this have to do with silver? Everything. When dollar dominance erodes, even slowly, the assets that benefit most are the ones that exist outside the dollar system. Physical gold, physical silver, hard assets with no counterparty risk. Assets that have stored value across every monetary system in human history. The pace of de-dollarization is debated. The timeline is uncertain. Whether it leads to a dramatic restructuring of the global monetary system or a slow, multi-decade drift, that is a legitimate question. But the direction is not in serious dispute among the institutions that matter. Central banks are buying gold. Commodity trade is increasingly being settled outside the dollar. The Bretton Woods-era framework is under more structural pressure today than at any point since Nixon closed the gold window in 1971. And in 1971, in the years that followed that monetary inflection point, silver went from $1.50 an ounce to nearly $50 an ounce in less than a decade. I am not predicting that silver repeats that exact move. I am saying that the conditions that historically produced generational commodity moves, monetary distress, geopolitical instability, structural supply deficits, and institutional complacency are all present simultaneously right now. That is a rare alignment, and rare alignments deserve serious attention. Section 6. What the smart money is actually doing. Let's be honest about something. While retail investors are reading Goldman's target cut and reconsidering their silver exposure, while the financial media is cycling through the same 5 talking heads debating whether silver is in a bubble, A very different conversation is happening at the institutional level. COT data, the Commitment of Traders report published by the CFTC, gives us a window into what large commercial and non-commercial traders are actually doing in the silver futures market, as opposed to what they're saying publicly. Commercial traders, the entities closest to the physical market, the ones who actually produce and consume silver, have been adjusting their hedging positions in ways that are consistent with expectations of continued price strength. Managed money, the hedge funds and algorithmic traders who drive short-term momentum, has been adding exposure on dips rather than using strength to exit. And physical silver investment demand, silver coins, silver bars, silver ETF flows, has been quietly and consistently positive even during the periods of price consolidation that preceded the current move. The retail narrative says, silver is risky. Goldman says sell. Rates are going to stay high. Be careful. The flow data says something quite different. Smart money does not announce its positioning in press releases. It does not telegraph its conviction in price targets that move market sentiment. Smart money accumulates. It waits. And then, when the conditions it has been positioning for finally arrive, the price moves in ways that leave reactive investors buying the top rather than the base. We may be at one of those inflection points right now. Section 7. The risk picture. Now, I want to be clear about something. Because intellectual honesty is more valuable than hype, silver is a volatile asset. The same supply-demand dynamics that can drive extraordinary upside can also produce sharp, painful corrections. Anyone who tells you silver only goes up, anyone who treats this as a guaranteed outcome, is either naive or selling something. The risks are real. If the Federal Reserve manages to thread the needle, if inflation comes down without a significant economic deterioration, if geopolitical tensions ease, if the dollar strengthens from current levels, then the macro tailwinds for silver weaken. Under that scenario, Goldman's target cut would look prescient rather than premature. If industrial demand disappoints, if the energy transition slows due to policy changes, if AI infrastructure spending gets rationalized, if a global recession reduces manufacturing activity, silver's industrial demand pillar weakens. And without industrial demand support, the precious metals case alone may not be sufficient to sustain current price levels. These are legitimate risks. They deserve to be priced. They deserve to be understood. What I am arguing is that the risk-reward profile, given the structural supply deficit, the monetary instability, the geopolitical complexity, and the historical precedents, is unusually favorable for those with a medium to long-term time horizon. This is not a call to act recklessly. This is a call to think clearly, to look past the noise, to understand what the data is actually saying beneath the surface of the daily headlines. So here's where we are as of this Sunday. J.D. Vance stayed home. The peace talks that could have lowered the geopolitical temperature collapsed before they started. Goldman Sachs cut its silver target at the exact moment silver was breaking out. The Federal Reserve is trapped between inflation credibility and fiscal reality. And silver hit $63, a level that most mainstream analysts were telling you was years away just 18 months ago. Each of these events is a data point. Individually, they can be explained away, rationalized, dismissed as noise. But taken together, mapped against the structural supply deficit, the de-dollarization trend, the monetary distress building in the bond market, and the industrial demand explosion from solar, EVs, and AI, they form a picture that is difficult to dismiss. The question I want to leave you with is this. If the conditions we've discussed today continue to develop, if the Fed cannot normalize without triggering a fiscal crisis, if geopolitical risk remains elevated, if the silver supply deficit continues to deepen, where does the price of silver go over the next 3 to 5 years? And more importantly, when the answer to that question becomes obvious to the mainstream financial media, to the retail investors reading Goldman's target cuts and waiting for the all-clear signal, will you already be positioned? Or will you be reading headlines that explain, in hindsight, what was visible right now, today, in the data that most people chose not to look at? The market does not reward hindsight, it rewards preparation. Think carefully, do your own research, and I'll see you in the next one.